$300,000. One withdrawal. 1 year. And the IRS took almost half. John Wallace from Columbus, Ohio. An engineer. For 30 years he did everything right. He maxed out his 401k, that's a retirement account through his employer. He contributed to his individual retirement account, his IRA. Not a single year missed. And then at 63 he decided, enough. Time to enjoy life. And he withdrew $300,000 in one shot. This isn't a story about greed. It's not about stupidity. It's a story about one mistake that thousands of people make, and about how that mistake triggered a chain reaction. A tax hit, tripled insurance premiums, a family crisis, and 12 months of panic. In the next 18 minutes, exact numbers. The strategy that saved his retirement. And a plan you can put into action right now. For illustration, let's imagine a typical engineer. Salary $120,000 a year. City of Columbus. 2 grown children. Mortgage paid off. His wife Carol, an accountant at a small firm. Starting at 28, John contributed to his 401k. Every January, a new limit, and he maxed it out completely. Early in his career, $10,000 to $12,000 a year. By the 20s, already $20,000 to $23,000. After 50, he added $6,000 to $7,000 extra, the so-called catch-up contribution, an additional amount for those over 50. By 63, across 2 accounts, a traditional 401k and an IRA, he had accumulated $1,400,000. Sounds like a victory. And John decided to celebrate. But here's what happened next. This is where the part begins that John's financial advisor never explained to him. Keep the number 300,000 in your head. It's going to come back several times. So, John retires at 63. It's not that he was fired, he was just tired. 35 years in the same industry. His knee hurts. In the morning, he doesn't want to get up to an alarm. Sound familiar? The first 2 months, euphoria. A trip to Florida. A new boat. The garage renovation he'd been putting off for 15 years. And then he looks at his bank account, his regular checking account, and sees there's enough for everyday expenses for about 4 months. Social Security. He decided not to touch it until 67. The right call. The later you start collecting benefits, the higher the monthly amount. Every year of deferral past full retirement age, plus 8% to the payout. But 67 is 4 years away. And he needs money now. And he does what seems logical. He calls Fidelity. He says, transfer me $300,000 from his traditional retirement account. Stop. This is where most people make a mistake worth hundreds of thousands of dollars. Not because they withdraw money, but because they withdraw too much at once. Look, he's 63. The early withdrawal penalty, 10%, applies to those under 59 and a half. John is 63. No penalty. He knows this, and he thinks, great, no problems. The problem isn't the penalty. The problem is that $300,000 gets added to his ordinary income for that year. Every dollar from a traditional 401k is ordinary income, like a salary, all of it, down to the last cent. In 2026, the federal income tax is progressive. Rates start at 10% and go up to 37. 7 brackets. The One Big Beautiful Bill Act signed into law in 2025 made those rates permanent. Now do the math. John already has income for that year, let's say a small employer pension, interest on deposits around $30,000 to $40,000. Add $300,000 on top. Total, nearly $340,000 in taxable income. For a single filer. That's not the 12% bracket. And not 22. Part of that money lands in the 32% bracket. Part in the 35. Federal tax over $70,000. Plus Ohio state tax. Plus the mandatory 20% withholding that Fidelity sent to the IRS right at the point of withdrawal. The 20% mandatory federal withholding applies to most distributions that are paid out in cash rather than rolled over to another retirement account. But 20% is $60,000. And the actual tax turned out to be higher. Much higher. The numbers don't lie. Here's what the calculator shows. John received roughly $240,000 in hand. And $60,000 went to the government immediately. Then when filing his tax return, Another 15 to 20,000 in additional payment owed. But that's only the first blow. Remember, chain reaction. The next hit came 2 years later. John is 65. He enrolls in Medicare, the government health insurance program for retirees. The standard monthly premium for Medicare Part B in 2026 is $202.90. $202.90 a month. Fine. Manageable. But then a letter arrives from the Social Security Administration. And in that letter, a very different number. The Social Security Administration determines who pays the IRMAA surcharge based on income reported 2 years prior. 2 years ago, that was the very year of the $300,000 withdrawal. IRMAA, income-related monthly adjustment amount. Put simply, a surcharge on Medicare for those who earn above a certain threshold. The higher the income, the more you pay. The cliff effect makes this especially painful. Even $1 over the threshold triggers the full surcharge for that tier. Potentially over $1,000 additional dollars per year per person. Instead of $203 a month, John pays considerably more. Depending on income level, the monthly Part B premium can rise from $284 to $690 a month. For John, with his income of $340,000, roughly $450 to $500 a month. Plus the Part D surcharge, that's prescription drug coverage, from $1,450 to $91 a month. For him and Carol together, that's an additional $3,000 to $4,000 a year above the standard rate. And that's when Carol said for the first time, "Do you even understand what you've done?" You know what's most frustrating? If John had withdrawn those same $300,000, but not all at once, instead $75,000 a year over 4 years, the situation would have looked completely different. Each year he would have stayed in a lower tax bracket. Each year his income for IRMAA calculations would have been below the surcharge threshold. One decision, to withdraw everything at once instead of phased withdrawals, cost him tens of thousands of dollars in additional taxes and surcharges. And now add something John didn't think about at all. When he starts collecting Social Security, every additional dollar of income from traditional retirement accounts affects what portion of his benefits gets taxed. Up to 85% of Social Security can become taxable. 85. Out of every dollar of retirement benefits, 85 cents falls under the tax. But let's step away from John for a minute, because his situation is not unique. According to Fidelity data from the fourth quarter of 2025, the average 401k balance across all ages is $146,400. But the median, meaning the level below which half of all accounts fall, $34,400. Feel the gap? That means a handful of people with millions pull the average up. And half of Americans have less in their retirement account than the cost of a used Toyota Camry. People with $1 million or more in their 401k, 665,000 accounts. Out of tens of millions. Back to John. That fall, the one when the IRMAA letter arrived, he didn't sleep for 3 nights. Carol found him at 2 in the morning at the kitchen table with a calculator and tax printouts. Crumpled pages on the floor. He was recalculating the same thing over and over, and every time the numbers stacked up against him. The irony, the safest option, pull the money out and put it in a regular bank account, turned out to be the most expensive. Because when money sits in a traditional 401k, it's not taxed until you touch it. Every withdrawal is income, and the size of that income determines everything: tax bracket, Medicare surcharge, the taxable share of Social Security. Something happened that turned all the calculations around. 3 months after the sleepless nights, John's son, Mark, an IT professional in Austin, called. Not for a family matter, a financial one. He said, "Dad, you don't need a financial consultant who sells products on commission. You need a fiduciary, a planner who is legally obligated to act in your best interest." The difference between the two types of advisors, commission-based and fiduciary, over 25 years can amount to $185,000. The commission-based advisor earns money on the products he sells you. A fiduciary earns a flat fee for the plan. He doesn't care which fund you buy. He cares that your plan works. John found a certified financial planner in Columbus. Her name was Rachel. First meeting, 47 minutes. Rachel looked at the statements and said, The damage is done, but we can limit the fallout and build a withdrawal strategy for the next 20 years. The next 18 months define John's retirement for 30 years ahead. Rachel put together a plan with 3 components. Remember them, because each one can change the picture for anyone currently between 35 and 65. First component, phased withdrawals. Instead of large lump sums, small withdrawals calculated to fill the tax bracket up to a certain ceiling and not a cent more. For John, this meant each year withdraw exactly enough to stay in the 22 to 24% bracket. Not 32, not 35. Each year convert just enough to fill the target bracket, usually 24 or 32%, without spilling over into the next. Second component, Roth conversion. A Roth is a type of retirement account where money grows tax-free and is withdrawn tax-free. A Roth conversion is the transfer of funds from a traditional retirement account to a Roth account. You pay tax on the converted amount in the year of conversion, but then the money grows tax-free and is withdrawn tax-free in retirement. Rachel explained, while John is retired and before he starts collecting Social Security, his income is low. That's the window, 2 to 3 years of minimal income. During this window, each year transfer $50,000 to $70,000 from the traditional account to the Roth account. Pay the tax now at a low rate, and after that silence. No tax on withdrawals. No impact on IRMAA. Roth distributions are not included in the calculation of modified adjusted gross income, the very income that IRMAA depends on. And Roth conversions reduce future required minimum distributions, which helps avoid elevated surcharge tiers. A Roth account provides tax-free growth and tax-free distributions in retirement. Plus, there are no required minimum distributions during the owner's lifetime. Unlike a traditional account, the money can grow as long as you need. Third component, and pay attention here, QCD. Qualified charitable distribution. In simple terms, this is when money goes directly from a retirement account to charity. Bypassing your wallet. Bypassing the tax authorities. Starting at age 70 and a half, you can transfer money directly from an IRA to a charitable organization. And those amounts count toward your required minimum distribution, RMD. Why does this matter to John? Because in about 12 years he'll start having required minimum distributions, RMDs, required minimum distributions. These are amounts you're obligated to withdraw from a traditional account every year after 75. Don't want to? You're still obligated. And every dollar is income tax IRMAA. The QCD limit in 2026 is $111,000 per person, or $222,000 for a couple. A QCD allows you to send money directly from an IRA to charity and exclude that amount from taxable income. For many retirees, this reduces federal taxes, lowers Medicare surcharges, and satisfies required minimum distribution obligations. John and Carol are members of their local church. They donated before, but before from a regular account. With a QCD, the same money goes to the same church, but from the retirement account. Directly, bypassing taxable income. Same charity. Zero additional tax. And now the action plan. Not for John. For you. If you're 35 to 50 and contributing to a 401k, in 2026, the limit is $24,500. That's the ceiling. But if you're 50, the ceiling goes up. Another $8,000 on top. And if you're 60 to 63, $11,250 instead of the standard $8,000. Not in addition. Instead, that's a total of $35,750 per year. Second, look at the balance between your traditional and Roth accounts. The combination of traditional and Roth accounts gives you flexibility in managing taxable income in retirement. You can withdraw from the traditional account, filling lower brackets, then switch to Roth when you risk landing in higher ones. Starting January 1st, 2026, employees over 50 earning more than $150,000 in the prior year can no longer make catch-up contributions pre-tax, only to a Roth account. This is a secure 2.0 rule. If you earn more than $150,000, your catch-up contributions automatically go to Roth. Third, plan your withdrawal strategy before you retire, not after. The difference in taxes between the right and wrong withdrawal sequence over 20 years of retirement is hundreds of thousands of dollars. That's not an exaggeration. That's math. And fourth, the Social Security Cost of Living Adjustment, COLA, in 2026 is 2.8%. Meanwhile, the increase in Medicare Part B cost, the standard monthly premium rose by nearly $18. That's about 10% in 1 year. Feel where the money is going. The raise from the government, 2.8%. The rise in health insurance costs, nearly 10%. That's not a mistake. That's the system. And the only way to fight it is to plan your income so that IRMAA doesn't eat your raise. And now a fact that might make you sit down. According to a Congressional Budget Office projection from February 2026, the Old Age and Survivors Insurance Trust Fund, OASI, could be depleted by 2032, 6 years from now. That doesn't mean Social Security will end. No, this is not a collapse. It's an automatic reduction of benefits to the level of incoming tax revenue. Roughly 77% of scheduled benefits. 77, not 100. Out of every dollar you were promised, 23 cents simply vanish. Accelerating factors. The Social Security Fairness Act, signed into law in January 2025, added $17 billion in retroactive payments. The One Big Beautiful Bill Act reduces payroll tax revenues flowing into the fund. And every day, roughly 10,000 baby boomers turn 65. John knows this. Now you do too. Remember the beginning? 300,000. One withdrawal. 1 year. John lost tens of thousands in taxes and surcharges. He nearly lost his family. But he found a plan, phased withdrawals, Roth conversion, QCD. And 18 months later, control returned. It doesn't matter whether you're 35 or 55. The question isn't how much to save. It's how to take it out the right way. And that question needs to be asked today, not on the day you quit. How much do you have in your retirement account right now? And do you have a withdrawal plan? Write it in the comments. Seriously, even if the number seems small, there's no judgment here, only math. If this video shifted something in your mind, hit like so the algorithm shows it to the people who really need it. And subscribe, there's a whole series on retirement withdrawal strategies coming. Everything said in this video is educational content. This is not financial, tax, or investment advice. Before making decisions, consult a certified financial planner or a tax advisor.